A lot of stock investors specifically invest in dividend-paying stocks because the regular cash flow into their bank account gives them a sense of security and hassle-free flow of money. In addition to this, there are multiple myths surrounding investing in stocks that pay dividends, and in this video, we will break those myths and discuss why specifically investing in dividend stocks can actually be a risky investment strategy. My name is Kanak and welcome back to my channel. If you find this video helpful, then please show your support by liking and subscribing to the channel. Let us start with the most common misconception. Dividend-paying stocks are safe and stable. Usually, it is the large, well-established and profitable companies that pay regular dividends. However, that does not mean every company that pays consistent dividend is a large, well-established and profitable. And just because a company is profitable and paying dividends today does not guarantee that they will continue to do so in the future. Let me share some examples. Have you heard of some of the largest companies such as General Motors, Kodak, Citigroup, Ford Motor Company, and so on? These are some of the largest companies that consistently paid dividends until they ran into financial trouble. And once they ran into financial trouble, their stock prices collapsed and a lot of investors lost money in the stock than what they earned through dividends. So assuming that just because a company pays consistent dividend means it is safe and stable investment is a wrong notion. The second common misconception is dividend-paying stocks are always profitable. Yes, dividends are a part of profit that the board of company decides to share with the shareholders. However, even companies that are not profitable can choose to pay dividends. Such companies can use their existing cash to pay dividends. Some companies even borrow money to pay dividends. And the reason why companies that are not profitable want to pay dividends is because they want to keep their shareholders happy. However, paying dividends just to keep the shareholders happy might not be the right decision for the long-term financial health of the business. And such companies can end up eventually running into financial troubles, which can cause the stock price to completely collapse. AT&T is a great example where the company has consistently paid a dividend for more than a decade despite not being profitable. However, the stock price of AT&T in 2023 is the same what it was 26 years ago in 1997. And in fact, it has decreased. So, over the long time period of 25 years, AT&T has paid about 6% dividends to its shareholders, with no stock price increase. So, this 6% return that investors generated by staying invested in AT&T is lower than the 10% return of the S&P 500. So, just because a company pays consistent dividends does not mean it is profitable, and the overall returns that you might get by investing in such companies could even be lower than the market average. The third common misconception is that because a company is paying dividends today, it will continue to pay dividends forever. Dividends are decided by the company's board, and they can choose to reduce the dividend payment if they believe the company needs the money to be reinvested in the business for either growth or survival of the company. And during bad economic times such as the 2008 financial crisis, a lot of companies that historically paid consistent dividends stopped paying dividends. So if you assume that you will receive the dividends forever and are relying on the dividend income, then that could turn out to be a risky decision. When the economy is bad, that is when you will need the dividend income the most. But unfortunately, that is when the companies might also choose to cut down their dividend payments. So do not assume the dividends will be paid out indefinitely, and specifically do not assume you will get them during bad economic times. The fourth point is more of an attitude rather than a misconception that dividend-seeking investors have. Some dividend-seeking investors believe that if a company is not paying dividends, then the company does not want to share the profits with the investors. That is absolutely not true. When a company decides not to pay a part of its profit as dividends to the shareholders, but rather reinvest the profits back into the business, that does not mean the investors won't get the benefit of the profit. The stock price of the company will eventually reflect the impact of the reinvested money. So, you are not losing out if the company does not pay a dividend. Berkshire Hathaway never paid a dividend, but the stock price appreciation over long term resulted in returns higher than most dividend-paying stocks. So, in a nutshell, you shouldn't invest in stocks just because they are paying dividends. And a consistent dividend payment is not a reflection of the financial health of the company, nor does it signal a higher than average returns from the stock. The right approach to invest in stocks is by holistic, fundamental analysis of the stocks, irrespective of whether they pay dividends or not. And if in case you need cash flow income, then sell a percentage of your portfolio at regular intervals depending on your income needs. If you find this video helpful, please show your support by liking and subscribing to the channel.